All right. Once again, apologies for that delay. I was having some computer issues. All right. So before I begin, just please take a note of the disclaimer stated on this introduction slide, the safe harbor there. I'll give a few seconds to read that. Anything I say is not financial advice, should not be interpreted or regarded as investment advice. All right. So this presentation is a mostly non-technical introduction to blockchains and the cryptocurrencies being built on top of this distributed ledger. One thing to note, even though we will be discussing some details, you don't need to know math or programming to use a cryptocurrency or decentralized application. Just like you don't need to know the details of what happens when you swipe your credit card at the local Walmart or post it to your feed on Facebook. And if you didn't understand a word I just said, don't worry, because we will walk through this emerging technology step by step. So most people have a grasp on what the internet can do, but very few understand how it works. The internet was never designed in hopes that the end users would understand what was going on behind the scenes, and blockchain technology is no different. If you ask someone to explain what the internet was back in 1993, their answer would probably further confuse you. If you ask yourself what the internet means to you today in 2021, it likely brings up images of a web browser, email, or maybe even TikTok. You have an implicit secondhand understanding of the internet because it is at the root of our everyday lives. So before I begin explaining blockchain, I want you to look past all the media hype and understand that at its core, blockchain is about empowering people to interact and exchange useful things. It's here to fix most everything that is broken with the internet today, such as the inability to trust unknown parties, centralized marketplaces like Amazon, eBay, identity theft, and entrusting third parties with our data, like Facebook. So what exactly is a blockchain? Well, a common mistake that is being made is thinking that Bitcoin and blockchain are the same thing, whereas in reality, Bitcoin uses blockchain technology to record transaction information. But blockchain is much more than just a currency. Blockchains enable the transfer of digital assets in any form in a safe, secure, and transparent manner without any middlemen. When I say middlemen, think of PayPal, Facebook, Uber, and banks. So the easiest way to think of it is think of a blockchain as a shared transaction log with a non-editable history and built-in security. The simplest comparison is to an accounting record book. Each block on the blockchain is like a line item in a shared record book. A new line item added to the book is equivalent to a new block added to the chain. The shared component refers to the fact that the ledger is not stored in one central location. In fact, there are thousands of copies stored all around the world in home computers and business servers. This is why the blockchain is often described as decentralized. And that's a key term here. On the contrary, every application we interact with today is centralized. For example, if your phone company is T-Mobile, they have their own customer database owned and operated by them. That same customer database is not available to AT&T or Verizon. Therefore, it is centralized. And even though blockchains are publicly available and decentralized, your data is automatically secured by mathematics. In fact, it is more secure than your local hospital's database. An example that hits close to home is the recent DuPage Medical Group hack of patient records. More than 500,000 patient records are believed to have been impacted by this recent cyber attack. Information like names, addresses, dates of birth, and treatment dates, and in some cases even SSN, social security numbers, were accessed. So how exactly does a blockchain work? Well, before a transaction can be added to the blockchain, the information must be confirmed by multiple computers who have a copy of the record history. The computers make sure every detail of the transaction is authorized and legitimate before agreeing or disagreeing to confirm the transaction. Once the block is added, it cannot be modified. Each transaction must perfectly match in every copy of the blockchain. If anyone attempts to modify a record, it will be rejected since the entire network has proof that the transaction is invalid. This verification process can be compared to paying your friend with thousands of friends circled around you. Everyone watched you hand your money to your friend, and if asked, would all agree that the money has been handed over. They could also confirm other details of the transaction, such as the amount paid, location, and the time. So the reason why blockchain is so secure is a bit complex, technical, and potentially boring to some, but it's important to review at a higher level to understand the value of the technology and the applications being built on top of it. Just like the Californians mining during the gold rush, today we have computers mining for Bitcoin. You may have heard of the term proof of work. Blockchain miners receive requests to verify transactions. These requests are known as blocks. If the miner chooses to accept the block, they run a complex computer program to validate the block, and they're rewarded in cryptocurrency like Bitcoin for their computational resources. Once that block is validated, it's passed on to a computer who adds the block to the chain. To ensure security, each transaction is screened by multiple computers all over the world. A transaction is only accepted as valid if more than 50% of the computers on the network accept it. I can't see any faces, but I'm sure there are some confused looks out there. So let's take a step back. Why is it so complicated? Let's say you're on a vacation with a group of friends. You may be exchanging money pretty frequently, paying your share of the scuba diving adventure or dinner. And that could quickly become inconvenient to keep exchanging cash or Venmoing back and forth. So you decide to keep a ledger detailing balances that you intend to settle at the end of the trip. This ledger is public in the sense that it is accessible to everyone in the group, like an Excel sheet, where everyone can add new transactions. Now, let's say your friend claims you owe $20 for a lobster you never ate. That transaction never took place. This is where digital signatures come in. Just like a handwritten signature, you should be able to attach a unique digital signature to a transaction that confirms it took place and that you approved of it. Blockchains do this with every single transaction to prevent fraud, particularly double spending. So what is double spending? An example of double spending is you claim to have paid, let's say, friend one, Bob, and friend two, Alice, $100 each, when you only have $100 total to give. Unlike cash, where you could produce a counterfeit bill, cryptocurrencies can only be spent once. Remember this concept, as this is the biggest problem that Bitcoin solves. So hopefully you've got a sense of what blockchains are and how they work. This should make it a little bit easier to understand why we need them. Any system that currently relies on a third party, a centralized system, is open to disruption using public blockchains. We're talking bankers, real estate agents, suppliers, Uber, list goes on and on. Individuals and merchants who supply a product or service can now interact directly with their customers. This is known as a peer-to-peer network. So today, when people are going to carry out a transaction, you're expected to trust certain institutions involved. Most people trust banks or MasterCard or PayPal to handle their money. People trust fund managers to invest their money. They trust companies like Amazon, Google, and Facebook to store their personal information. But what if there is a way to safely and securely cut out these middlemen, have a new trusted method to transact, and save money on fees? With blockchain technology, we gain transparency, decentralization, security, reduce costs, and increase speed. A good way to get an idea of how blockchain works outside of purely financial transactions is to use a vacation rental app like Airbnb as an example. Today, every time a person rents a home, it creates a transaction, and the middleman in these transactions is the rental platform itself, Airbnb. Airbnb keeps all the information of the owners, the homes rented, and the renters in its own database. Now, imagine a decentralized Airbnb-like application where vacationers can directly rent a home or apartment from a homeowner. There would be a public listing of who has rented it and who the owner is. And in this new model, anyone can join and access the records. Every time a property is rented, a new transaction is recorded and all the databases are updated. In this case, the blockchain. This new Airbnb is operated by people who join the network without the need for a third party to centralize the records. This type of application could reduce rental costs significantly, as there's no longer a central party like Airbnb to take a substantial cut of the homeowner's income or upcharge customers. Now let's talk about Bitcoin. So in a research paper introducing the digital currency, Bitcoin's anonymous creator, Satoshi Nakamoto, referred to it as a new electronic cash system that's fully peer-to-peer with no trusted third party. Basically, it's a currency controlled by the people, not financial institutions. It's no accident that this paper was published in 2008. The economic collapse that occurred helped the masses to realize that we cannot trust banks as much as we thought we could. Sometimes they wouldn't even have the money to give to us. Then the pandemic hit last year in 2020, forcing us to further merge our physical world to the virtual realm. Online shopping is at an all-time high, so it's only natural that our currency migrates to the digital world. Bitcoin is just one of the solutions to the problem of cutting out middlemen and providing a secure manner to transact digital money. Recall the double spending scenario I proposed earlier. Today, anything publicly available on the internet can be replicated with minimal effort. Anyone can plagiarize a Wikipedia page or a blog post or even re-upload a YouTube video. It would be entirely pointless and fraudulent if digital money could be easily replicated or double spent. So here's how the process works with Bitcoin. When you send Bitcoin, you pay a small fee, also in Bitcoin, for a network of computers to confirm your transaction is valid. Your transaction is then bundled with other transactions pending in a queue to be added to a new block. The computers then work to validate this list of transactions in the block by solving a complex mathematical problem. Once solved, the block is added to the network, and your fee, combined with all the other transaction fees in that block, is the miner's reward. For many, Bitcoin may seem complicated, but it isn't when you view it as a combination of three things. First, it is a peer-to-peer payment system. You can send money, BTC, from one person or company to another without the need for a bank. Sending money this way is faster, more secure, and cheaper than using traditional methods. Now you may be thinking, don't we already have peer-to-peer networks like PayPal or Zelle? Well, not really. These are third parties that are making commission off of each transaction that takes place, and they get to determine the percentage that they take. Second, a decentralized system. Bitcoin is a decentralized system like the internet, so it's not controlled by one entity and cannot be stopped by any third party. And lastly, Bitcoin is considered digital gold. It's a store of value like gold, but of course it is much easier to transfer than real gold. So we talked about Bitcoin, but what about other cryptocurrencies? Well, as of today, there are over 11,000 cryptocurrencies that exist. So I've only decided to pick the two major coins, Bitcoin being one of them, and we'll dive into Ethereum next. But before we do, let's pause for a couple minutes to answer some questions.
So Ritvik, we do have a question.
Sure.
The person is asking, what happens when the 21 million Bitcoins are mined? How would the miners be incentivized to verify transactions thereafter?
That is a great question. So the miners would still receive transaction fees paid in Bitcoin. They may not be mining new Bitcoin or creating new coins, but they're still receiving a payment from users that are transacting on the network. I hope that answers your question. They're still getting paid, they're still doing work. Yeah.
Right now, that's the only question.
Okay.
If anybody has other questions, please feel free to note it down in Q&A. So I think there's another follow-up question. So there are transaction costs.
Is that the follow-up question?
Well, no, not really. It is just a question. Are there transaction costs? So what is the difference between the banks and the miners?
Yeah, so the bank is, as mentioned, a centralized party. They get to determine the fees, whereas in a network that is decentralized, every participant in that network determines the fees. You know, how much activity is going on in the blockchain. That's how the fees are determined. Are those all the questions?
Yeah, right. That's it. And the person says understood.
Okay.
I have another one actually, if you want to answer that one. I do not understand how this is safe.
How Bitcoin is safe?
Yes.
Okay. So we'll get into it a little bit more, but essentially, as I mentioned before, that answer is a bit more complicated and out of scope for this introduction presentation. But it's all backed by mathematical proofs and cryptography. And cryptography is essentially math combined with computer programming. So that answer is a little bit more complicated, but I hope my higher level overview will kind of give you an idea of how it works. You know, the decentralization is one key part of it. Because you have so many different computers all over the world confirming transactions, it ensures the security and safety of what's occurring. And you know, one malicious node or one malicious computer cannot modify the blockchain.
Now there are a few more questions coming up.
Sure.
And they are actually in the chat section. I would request everybody to post it in the Q&A only because I can monitor it in one area. Mm-hmm. Some of the questions may get answered as the quick continues, but I'm just going to mention those questions. Sure. How is the fee price determined? Who are the determiners? And then another question is, so what does it mean by trading BTC on trading apps such as Coinbase?
Sure, so two separate questions. So the first one, how is the fee price determined? As I mentioned before, it's determined by the network activity. Specifically in Ethereum, which I'll be talking about next, it depends on what kind of contracts are running, what type of applications are running, how many people are using the network at a time. Sometimes the network can become congested, and you know, the miners have to process more transactions than usual. In that case, the fee may hike up a bit. So the determiners are the participants of the network. I hope that answers that question. For the second question, what does it mean trading BTC on something like Coinbase? Coinbase is a centralized exchange where you can essentially, from your bank or your debit card, fund your account and exchange USD, US dollars, or any other currencies that are accepted on those exchanges for Bitcoin. So you're leaving this ecosystem, the traditional financial ecosystem of US dollars, and entering the world of cryptocurrencies and exchanging for a Bitcoin or Ethereum. Are those all the questions?
No, actually, there are quite a few more.
Sure.
Is the floating value determined by supply and demand? When all Bitcoin is mined, will the value spike or crash?
Sure. So again, please don't take anything that I'm saying as financial or investment advice. this is merely an analysis, a personal analysis and understanding of how economics works. So yes, the value is determined partially by supply and demand. When all Bitcoin is mined, you would expect that the value would continue to increase as more participants want to join the network. So in that case, that means there's higher demand and the supply is all taken up. So in theory, the price would rise. I'm not going to discuss any specifics, numbers or anything like that. But yeah, that's how I would think that would play out.
Okay, thanks. Just one last question before you can resume. What happens if the internet goes down for an extended period of time?
Sure. So the internet is, I mean, it's not entirely centralized. So the internet would only go down in certain areas or pockets of the world. If the entire world lost internet access and connection, that's like an apocalyptic scenario that I cannot even describe. Yeah, the likelihood of something like that happening is slim to none.
Okay. I think we can resume and then answer the remaining questions.
Sure, yeah.
Later on. Thank you.
Okay. Yeah, thank you, Sangeeta. Okay, so if the economy has to go completely digital, as we are witnessing currently, then we need to be able to represent most physical assets, property rights, identity, gold like Bitcoin, cash digitally. So in late 2013, after traveling and meeting with Bitcoin developers and realizing Bitcoin's limitations, developer Vitalik Buterin published a white paper. And a white paper is essentially a research paper in abstract explaining a new technology. And he proposed a platform that combines traditional blockchain functionality with one key difference: the execution of computer code. So the Ethereum blockchain lets developers create sophisticated programs that can communicate with one another on the blockchain. We can now create tokens to represent any kind of digital asset, track ownership, and execute functionality according to a set of programming instructions. These tokens can be music files, contracts, concert tickets, or even a patient's medical records. Most recently, non-fungible tokens, or NFTs, have become all the rage. NFTs are unique blockchain-based tokens that store digital media like a video, music, or art. Each NFT has the ability to verify authenticity, the past history, and the sole ownership of that piece of digital media. NFTs have become wildly popular because they offer a new wave of digital creators the ability to buy and sell their creations while getting proper credit and a fair share of profits. Now let's talk about smart contracts. So different businesses deal with each other to exchange services or products. All the terms and conditions are signed by the involved parties in the form of agreements or contracts. However, these paper-based contracts are prone to errors and frauds, which challenges the trust factor between those parties and raises risks. Smart contracts perform similar functions as paper-based agreements. The differentiating factor is that they're of course digital, but also self-executable in nature. Self-executable means that when certain conditions of the contract are met, a piece of code is automatically deployed. Ethereum introduced smart contracts to the blockchain ecosystem. Smart contracts can be used for different situations or industries such as financial agreements, health insurance, real estate property documents, crowdfunding, etc. Another notable use case for smart contracts is supply chain. Blockchain can be leveraged to manage and sign contracts and provide a chain of custody. For example, smart contracts can be used in the tracking of coffee beans. Let's say the name and quantity of a particular coffee bean shipped from a farm in Africa is to be packaged and delivered to a port in Africa from the farm, and then finally arriving at a port in the US. Now, a smart contract with all the valid data like the information about the bean, information of the farm, the quantity of supply, the timestamps, etc., can be created. This smart contract is responsible for tracking the product every step of the way. And since the smart contract works on certain defined conditions, no malicious actor can make changes to the contract, ensuring the trust and authenticity of the beans. And then you as the consumer can then scan a QR code on the packaging and view the chain of custody in an app installed on your phone. Now let's talk about securing your digital assets. So to buy and invest in cryptocurrencies like Bitcoin or Ether, the first step is to choose the right cryptocurrency wallet. Just like you store cash, credit, and debit cards in a physical wallet today, the wallets of the future are digital. Think Apple Wallet or Google Pay, and they can hold several cryptocurrencies. So a public key, also known as your wallet address, allows other users to send you crypto. A private key unlocks your crypto to you. So your wallet address is similar to like a username or an email address, and the private key is similar to your password. Private keys are only known to you, so it secures your balance against any hacking attempts. However, losing your private key means losing all the coins in that wallet. So there are two different types of wallets. We have hot and cold. Hot wallets are the wallets that rely on internet connectivity, and because of this, they're considered less secure. However, they're highly accessible, but there is a trade-off with security threats and attacks by fraudsters. Hot wallets are more user-friendly also, but exchanges and wallets that are connected to the internet could easily be hacked. Cold wallets are offline, therefore they're more secure by nature. Examples of these are a paper or a hardware wallet. Selecting a wallet that works for you is finding a healthy balance between security and convenience. Perhaps you store a small amount of coins on a hot wallet or on an exchange, and a majority of your investment on a cold wallet. So online or web wallets are the wallets that allow users to access the wallet through a web browser. It's never suggested to store all of your cryptocurrencies into these type of wallets. Both the online wallets and exchanges like Coinbase, Kraken, Binance are all vulnerable to cyber threats and are attractive to hackers. However, the online wallets are the fastest way to complete transactions, and they allow users to manage a significant number of cryptocurrencies. Mobile wallets are the wallets that can be downloaded and installed onto your iPhone or Android. These wallets are based on the internet also, therefore users have to protect them from these security risks. Users can quickly scan a QR code from mobile wallets and make payments. Lastly, a desktop wallet is an application on your Mac or Windows PC that is a more secure way to store cryptocurrencies than a mobile or online wallet. Desktop wallets are best because they store the cryptocurrencies in offline mode, hence providing more security. Probably the best wallet in terms of security are the hardware wallets. However, there's a trade-off of convenience with these. These devices come with an abundance of security measures, including PIN codes, physical buttons for transfer confirmation, passphrases, etc. The con of this particular wallet is the price tag. Whereas other wallets are mostly free, a hardware wallet could range anywhere from $40 to a couple $1,000, depending on the feature set. The cost really represents the quality of service, as these companies are using materials that are hard to break and software that is nearly impossible to hack without having the device physically in your hand. I've listed some of the popular wallets of each type in the bottom left hand of this slide. MetaMask is a browser extension, therefore a web wallet. Argent is available on the mobile app stores. Electrum is a desktop wallet. And the Ledger Nano is the hardware wallet pictured to the right. So critics have noted the following challenges in blockchain. And the first one is nascent technology. We have to realize that our monetary and banking systems are over 200 years old. Bitcoin is merely 12 years old at this point. So most of the concerns in this regard stem from hacking or supercomputers taking over the network. When isolated, it may seem that blockchain technologies, especially Bitcoin, consume large amounts of electricity. But in comparison, if we were to assume that all banking and financial transactions are replaced by this new system, then the sum of the footprint of these cryptocurrencies is significantly less than energy used by the systems we have in place today. We're talking the banks, keeping their servers up and running. In fact, most of the Bitcoin mining farms utilize green energy, such as solar or wind today. In terms of cultural adoption, this will take place over time. This is a silent and bloodless revolution that cannot be halted. Cost-wise, international payments and transaction fees are way cheaper already with the existing cryptocurrencies. And building the infrastructure for blockchains will pay off over time. In terms of regulatory status, taxes, etc., money is power. Blockchain is self-auditing and transparent, so compliance is already simplified inherently. But governments and banks are scared, as this revolution is going to shift the power back to the people. First, they laugh at you, then they fight, and when they can't beat you, they join. So each of these bullet points could take a few hours to discuss, so I'm simply offering a list of common critique floating on the internet. Okay, so you may be thinking, great, I understand what blockchain is and what the two major cryptocurrencies accomplish and how to safely store my coins, but what can I do with the coins today? Well, you have a couple of options. Just 8 years ago in 2013, a single Bitcoin was worth $100. Today, one BTC is worth nearly $50,000. So your first option is to hold your assets as an investment. Another option is to use your coins to facilitate payments. You could send money to friends and family anywhere in the world, or even buy a pizza, which was actually the first use case of Bitcoin. You may have heard the recent news that El Salvador has become the first country to make Bitcoin legal tender. This is bound to happen everywhere else in the world. Another option is to lend your coins or hold them in certain accounts that earn interest. For the last decade or so, banks have been giving less than 1% yield on savings accounts. Today in the crypto world, you could earn anywhere from 4 to 40%, depending on how much risk you're willing to take on. And as mentioned earlier, if you're the creative type, look into selling your work as NFTs and collect these lifelong royalties. These are just a few examples of the utility of cryptocurrencies. I implore you all to continue your research and education with some of the resources I've listed on this slide. If you're looking for more, feel free to send me an email and I'd be more than happy to point you in the right direction. So some of these resources, I've named a few of the most popular centralized and decentralized exchanges, Coinbase, Kraken, Binance, decentralized wise, Uniswap, and 1inch. Below that are some applications in the decentralized finance space. This is a topic that is for another day, but feel free to explore those pages, Hedgic and Mirror.finance. Some popular lending protocols are listed on the top right. We have Aave, Maker, and Compound. And finally, the links to the official Bitcoin and Ethereum projects, as well as a cryptocurrency index, CoinMarketCap, and a news website, CoinDesk, are listed. And I'd be more than happy to provide this presentation to anyone who requests for it. Maybe I could send it to Sangeeta and she could distribute it.
That will be perfect. Thank you, Ritvik.
Yeah, so thanks for listening, y'all. I know that was a lot to digest. Special thank you again to Sangeeta and the Schomburg Library for reaching out and putting this together. If there's any interest at all in diving deeper into other topics in this space, I'd be more than happy to present on those in the future. Let's go ahead and open the floor to the rest of the questions. We have about 20 minutes left. My email is listed on the slide. in case we run out of time and I don't get to answer your question, just shoot me an email.
Okay, so we have a question which asks which current projects may become better than Ethereum and therefore replace it.
Yeah, so there are several projects out there that are looking to increase specifically the transaction speed compared to Ethereum, and the consensus mechanism. Consensus mechanism means how the computers in the network come to an agreement. There's a project called Solana that is picking up steam. There's another one called Avalanche. They all have different consensus mechanisms and certain technological pieces that improve the transaction speeds. However, I think it would be foolish to say that they will replace Ethereum. Ethereum has one of the biggest developer ecosystems in the blockchain and open source space, and they're constantly improving it. In fact, as I mentioned before, proof of work is a consensus mechanism, the one that Bitcoin uses, the mining. That is actually, Ethereum currently also runs on proof of work, but they are making a shift to something called proof of stake later this year or early next year. So hope that answers that question.
What is the hack risk for a brokerage account like Schwab versus a crypto exchange account like Coinbase?
Good question. Honestly, I would think they are pretty similar, considering the fact that Coinbase is also a centralized system. It's a centralized exchange, and Schwab is a centralized bank account. So in that sense, the real protection of your assets comes from the decentralized nature. Holding on to your coins yourself, your crypto, your keys, your crypto. So I would expect the hack risks to be similar for two centralized systems.
What is Ethereum 2.0 and why is it being introduced?
Yeah, sure. Great question. So Ethereum 2.0 does many things, but the biggest one is what I just mentioned, the switch from proof of work to proof of stake. Why is it being introduced? Again, to solve the problems of transaction speeds, bringing together a better consensus mechanism, because proof of work uses a lot of energy, and proof of stake will significantly reduce that overhead. If you want more details on Ethereum 2.0, go ahead and send me an email. I have a great write-up that I can send over to you.
How do we get Bitcoins, etc.?
Yeah, so let me go back to that slide for a second. If you want to buy Bitcoins today, you can go to any of those centralized exchanges and basically fund your account with fiat USD and purchase Bitcoin, Ethereum, and several other cryptocurrencies. That is the simplest way to enter the system.
Do you have a YouTube channel? Can you recommend a YouTube channel?
Unfortunately, I do not have a YouTube channel. One YouTube channel I could recommend is 3 Blue 1 Brown. He has many videos on cryptocurrencies, Bitcoin, and blockchain that are very helpful. And he has phenomenal graphics that will kind of walk you through the process. He gets a little bit technical, but I would recommend that.
And there's another question that has come up. There were a couple from earlier too.
Sure.
Is there a finite number of Bitcoins?
Yes, as I think someone else asked it or mentioned it in their question before,
Okay.
there's going to be 21 million Bitcoins mined.
Okay. Have you personally made a significant amount of money from blockchain Bitcoin investment? And then the person says, none of my business, but just,
No comment.
okay. I have a person who has raised his hand.
Okay.
I'm not too sure if that is by mistake or if he prefers to speak. Are you okay if we allow this person to speak?
Sure. No problem.
Okay. So Dawn and Barb, you all have asked to speak, and go ahead and ask your question.
I can't hear you if you are speaking.
Yeah, we are not able to hear you, though you are not muted. You are unmuted, but
Yeah.
we are not able to hear you. Might be,
What are you doing?
maybe you might want to type in your question.
There. I just unraised the hand, I think.
No, it goes blue when you do.
Yeah, no worries. Thank you. Okay, does anybody have any other questions? I think I am not seeing anything else.
Okay.
We'll just wait for a few more seconds and okay. It looks like we are doing good. I don't see any other questions. I'm just scrolling through job. You're getting some good, great jobs. And can you repeat the YouTube name they're asking?
Oh, yes. It's 3 blue, 1 brown. It's the
Would
number
you-
3, the word blue, the number 1, and then the word brown. I could probably type it out somewhere.
Yeah.
Is it in chat?
You could chat, yes.
Okay. Yep, that's right, Wayne.
Yeah, it's coming only to the panelist, so I'll just send it to
Okay.
everybody.
Sure.
Yeah, I'll just send it to everybody. Okay. And there's, I think, another question. There are so many memes. How do we analyze them?
Sorry, could you repeat that question?
There are so many memes. How do we analyze them? MEMES.
Oh, memes. Okay. Yeah. There are many memes, just like any other thing that exists on the internet. If you're referring to something like Dogecoin, which is widely considered a meme coin, how do you analyze them? The biggest things I would look at are, one, the team. Some cryptocurrency projects have an anonymous team, but they will have a track record on, let's say, GitHub. GitHub is a place where they can upload and contribute code to a number of projects. So look out for GitHub commits is what it's called. Look out for the website, which you should be able to tell whether or not it's a fraudulent website. There should be established pages. It shouldn't just be jargon and stuff you don't understand. There should be a simple way to explain what the project is about. You should look out for a white paper, as I mentioned before. Most of these projects have white papers. Other things you can look at are a lot of these projects have a Discord channel or a Telegram channel. And so if you join those, you can ask questions with the founders and the programmers directly, and get a sense of, is this thing real, or is it, someone trying to pull the rug from under us and make a bunch of money and leave.
Okay, Ritvik, thank you so much for all that presentation. It is a lot to absorb, and I'm so glad it's going to be available on the YouTube channel, because I think I, for one, will be viewing it again to get a better sense of it. A lot of good information, got a lot of good questions. So everyone, and I should probably up my video. Just trying to. Okay, so Ritvik, thank you again. I'm so sorry. I was just trying to get my video on, but that did not happen. But do send me the slides. I already have a few requests coming in. I can forward it to the people who are requesting the slides. Anybody who is looking for slides can always contact me at sbhargava@stdl.org, and I will be more than happy to forward it to you.
Absolutely. So no more questions?
No more questions. So we can call it a day, and have a good night, everybody. Thank you so much. Well, there actually happened to be a few more questions. I'm so sorry.
Okay, sure.
They just came in and I'm just seeing them.
Sure.
Such as Dogecoin, etc. And I don't know in what relation. I think it was to do.
Dogecoin. Yeah.
Yeah. What kind of analysis is required to separate reputable networks with shams?
So yeah, I kind of touched on that already, but again, just look at the white paper, look at their website, look at any Discord or Telegram channels that they have, any chats going on about the project. Perhaps they'll have a YouTube channel explaining the project and showing the application in action. Look at the team. I think those are the biggest things to look for, and look for network activity. Because as I said, blockchains are completely transparent. So you can view exactly what's going on the blockchains and see if, people are actually using it, and that it's not the same wallet sending, back and forth. Any others?
Okay. And there was just a comment that, or maybe like a question, not asking investment advice, but would it be wise to stay within the top 20 in market capitalization?
Okay. That is a difficult question to answer. Kind of tiptoeing the edge there, answering that. But in general, yes. What you would see listed as the top 20 are the networks that are used the most and have the most effort behind them. But it's not a one answer fits all kind of question. You have to look at each project individually.
Are there cryptocurrency advisors like financial advisors? And if so, where can we find them?
I'm sure there are. I do not know of any myself. Yeah, I can't really answer that question. I'm sorry.
Yeah, lots of questions. I'm sorry, Ritvik will not be able to answer because he cannot give advice. And unfortunately, this is more of an informational program, so we have to respect that. One more question. How do you become a miner?
How do you become a miner? Great question. So in the Bitcoin world, it's a little bit different now. We've come to the point where there is so much computational power, also known as hash power, hash rate, in the network, that individuals, you can become a miner, but it may not be profitable for you. However, there are several other cryptocurrencies and blockchains where you could become a miner and be profitable. How do you become one? If you go to, for example, Bitcoin or the Ethereum websites, I will pull that up once again. Bitcoin.org, Ethereum.org. They have an entire section on how to set up your computer as a mining node and to join the network. And it's the same for every other project. They will have either written in the white paper or a page on their website, kind of detailing what software to install, how to set up your wallet, and get started mining. But do keep in mind that it requires a lot of computational resources in most cases. And so you need to have a PC that is powerful enough and is on 24/7. These nodes cannot go down. I think someone asked the question earlier of what if the internet goes down? Well, really, you should be asking what if all the nodes go down? And truthfully, that won't happen because, like I said before, the internet will only fail in pockets of the world, and the whole world won't just lose internet access in one go. So yeah, you can also watch there's some YouTube videos instructing how to become a miner that kind of they take you through the website steps, that may be easier to follow if you're a visual learner.
Okay. Thank you, Ritvik, again, and we are going to call it a night. And everyone have a wonderful evening, and see you all some other time.
Alrighty.
And feel free to contact the reference desk at refdesk@stdl.org if you all have any questions. And I'm just going to end the program now.
Absolutely, and my email is there again. If you have any other questions, just shoot me